Right, good. Hello, everybody. Welcome to today's webinar. This is Adrian speaking, Head of Trading here at Trend Signal. And what I'm going to do today on our screen share is talk about how to trade news and events. So we're going to be talking about what might seem boring stuff like the economic calendar and so on, but I'm actually going to take you through first of all how to read it, a pretty simple, clever trick to be able to understand it properly, why it's important, and what we can do about it from a trading perspective as well. Because actually, what these news and events do is that they provide us with fast speed opportunities from which we can trade with a little bit more oomph than we might do otherwise. So, should be really interesting, sort of half hour, 40 minutes or so. This is a live session. I am talking right now. And if you could let me know that the sound is coming through loud and clear, that'd be great. Just type something into the questions box, please. Now, if you're on GoToWebinar, if you're on a downloaded computer, it's going to look like this. If you're on a like a tablet or smartphone, it's going to look like this. Just type something into the questions box. That'd be fantastic. We're also streaming on the likes of YouTube and Facebook and wherever else. So just let me know on those. I do find it a little bit more tricky to monitor the chat, but if you can keep the participation going on those as well, that'd be fantastic if that's where you're watching it. But otherwise, AJ, thank you. David, James, Carl, that's great. Can I get an idea from everybody about how long you've been trading for so far? For me, I've kind of categorized this as a relatively beginner topic. However, I'd be interested to know whether you're brand new to trading, whether you've been maybe trading 3 months, 6 months, a year, 5 years, where you're at with it. That would be great. Just in the chat, please. So please do indeed let me know. Okay, Richard, 3 months. Jonathan, 6 months. Margaret's brand new. That's fine. Again, let us know if you're sitting there. Don't sit there in silence, please. It'd be really interesting to know. Just get an idea about what you guys feel about this topic as much as anything else before we do really get into it. So, what am I going to do first of all is just take you through a short disclaimer, really to say that spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. Okay, so look, let's get on with it. The thing about trading is that however you trade it, and however you trade these markets, it's really important that you trade according to a plan. A lot of traders don't have a plan, but those that do tend to get much better results. A bit like business owners that have a business plan probably do tend to do a bit better than those that don't. One of our customers kind of put this relatively well a while back, actually, a good couple of months, a couple of years ago now, but it just demonstrates it nicely. If you can follow rules, take your time and listen to your coaches, you'll make money. If you don't listen, have no patience and can't follow rules, go and do something else because trading isn't for you. Today's session is very much about a pretty important rule. It's about helping traders to get a good understanding. Oh, is the sound not coming through? Let me just hang on 1 second. Bear with me. Is the sound working? I'm going to talk right now, and I'm going to talk in yabba, 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 yabba. If you can hear me, do let me know. I'm guessing that it's not coming through. Is the sound working? I might have to just change something very quickly. Let's just see if I can flush that through. Is that sound working better now? Can you let me know? Hello? I'm talking. Hello? 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 Is the sound working? Please do let me know if you're in the session. Yes, no, let me know. This is fun. You hear me? Can you hear me? Yes or no? Please do let me know. Is the sound working? Hello? Goodness sake. Is the sound working now? Everybody, if you just let me know whether the sound's coming through, that'd be great. Sorry, it sounds like we're having a bit of a shocker. No, great. Okay. Bear with me. It's really, is the sound working? Not for me. It can't hear me. Okay. Okay. Still no. Okay. Okay. Right. Give me 2 seconds.
Welcome to the webinar. You have entered as an organizer and may now speak to any other organizers or panelists on the line. When you are ready in the presentation, press Start Broadcast button on the GoToWebinar control panel to allow attendees to hear you.
Hello.
This system will notify you once you begin your broadcast. The
Right, how's that?
broadcast is now starting. All attendees are in listen-only mode.
Is that working better now? Can you hear me? So AJ, you can hear me. Okay. Can you all hear me now? Hello. Hello. Ah, there we go. Look at that. Fantastic. Okay. Nothing like a good live session for throw a few gremlins in there. See, at least I know people are listening and they're out there trying to learn, which is a good thing. Sorry about that. What a total pain in the backside. Okay, so this is Adrian speaking. Thanks for being online, guys. I was wondering why nobody was answering any questions. Now we know. So what I'm going to be doing today is taking you through about trading news and events. Why is that important? Let's just go back to the start. It's important because actually these things are market stimulating events. They can create movement and that creates opportunity. But in addition, another problem is, a problem with news and events is it can create risk as well. So if we don't understand it, if we don't know about it, then we're bringing risk into our trading plan and that can be a problem. Like one of our members here to say here, if you don't listen, have no patience and can't follow rules, go and do something else because trading isn't for you. This is one of the rules that I want to go through with you guys today, particularly if you're day trading. It can give you opportunity if you approach news and events the right way, but it can also reduce risk if you approach it the right way as well. All right, so let's get on with it. Let's go through it and let's talk about some of the interesting stuff. So look, the thing is that every week we will see major news events, and these news events are impacting the markets. This could be, we're talking about inflation a lot lately, aren't we? Give us a quick yes or no, guys. Do you understand the economics associated with market movement? Do you understand why inflation changes the direction of Forex markets? Do you understand why interest rates change them? Do you understand about growth and what that does to currency prices and so on? Give us a quick yes and no in that questions box, please. You don't necessarily have to know, but it does give you a bit of an idea. And I'm going to give you a very clever, it's not clever at all, an interesting little shortcut, if you like, that can help you a little bit, not too much. A couple of yeses, a few no's. Not really, says Marilyn. That's fine. No, says Raphael. Okay. We're going to talk about that. I'm going to demystify it. All right. But the thing about this is, depending on the style of trading that you are doing, it's important to be aware of where those banana skins are. I'm going to go through exactly why that is the case in just a second. But when we're talking about this, the news is going to impact our trading more so, depending on the importance of the news and also the style of trading that we do. So, for example, if you're an end of day trader, which is a little bit more than I am, I do some day trading, but it's not quite so much. I don't tend to be too concerned about news. If I'm going to trade stocks, I need to be aware about where their earnings are. So when they're reporting their quarterly earnings or their half-yearly earnings, I need to be aware of that. If I'm going to be trading currencies or indices, I need to be aware principally about interest rates, and I need to be aware of something called non-farm employment change or non-farm payroll. Why? Because these items typically have the greatest likelihood of moving the market. And we'll talk about that and what that all means in just a second. But being aware of these items allows us to close positions down, to manage risk appropriately. If you're a day trader, and you're looking at trading short term, it's very important to be aware about where these major items are, because, well, it's a bit of a gamble, you know. Because so if you're day trading and you're carrying a trade over into an economic data announcement where the interest rate data might be changed or might not be changed, or inflationary data might come out and it might be better than expectations or worse than expectations, you have no idea. It's a total lottery, it's a total gamble. So to be running a trade over that is basically accepting and introducing risk into your trading. And I can tell you why the odds will always be against you in that style. Now, what we are going to do is talk about how we can take that information and we can use it to our advantage. And we're going to go through that very much so in today's session. Okay, but what you've got to be aware of when you're looking at a particular opportunity is a little bit like if you're going to play golf. You need to understand where the water is, where the bunkers are, where the out of bounds is. It's just about being able to understand where those potential hazards are so that we can trade accordingly. It really isn't that complicated. And the main reason why running trades over economic data or corporate results, it's always going to be against you, is because of the risk of gapping and slippage. Do we understand, yes or no, in the questions box, what gapping and or slippage is? Do you know what these phrases are? Nope. Nope. You don't have to know. I'll happily go through it. You know, it's part of the learning process. Okay. Well, let's go through it. You know, Marilyn does. That's cool, but overwhelmingly knows that. So gapping and slippage. So what is gapping and slippage? Well, gapping is something a little bit different. So gapping is really where a market moves from one price to another price without trading in between, basically. So a gap in between a price. So if the market it's easiest to probably explain with a stock or a currency. So let's say you're trading pound dollar at, I don't know, let's say it's trading at 1.2, and that's where it closed out on a Friday night. You're long, okay, so you're speculating on prices rising, and you buy pound dollar on a Friday. It closes at 120, double O's, and then the following the Sunday night it opens, and let's say it opens at 1.2050, for example. So in between Friday night's close and Sunday night's open, there is a 50-point jump. Okay, that's the gap. So there's no trading in between that. So you'll see it a lot with stocks. So a stock might close at 100 pence on a Tuesday night, and it might open at 103 pence on I don't know, a Wednesday morning or whatever it is. So that is basically a gap in price. And that typically happens while markets are shut, but you can also get gaps like that while markets are open when there is a big economic data announcement, a shock that happens to the market. Now, why is this important? It's important because that gapping, that super fast movement in speed, can create something called slippage. Now, slippage is basically this. Let me just clear that off. Slippage is basically, and it commonly happens more to a stop loss than a limit. It's simply down to the way stop losses and limits are held with exchanges. But basically, let's say again we're along of pound dollar, and let's say that we had a stop loss in at I don't know, 1.1950. And let's say the open on Sunday night was at 1900s. Okay, so I'm long from 120. I've got my stop loss at 119.50, and I've got my the open on the Sunday night comes in at 119.00. Okay, so that means obviously it's gone lower than my stop loss, so I'm going to be closed out of the trade, right? It's going to hit my stop. The question is, where am I filled? Okay, so simply in the questions box, guys, am I filled at A or B? Let me know. So my stop loss, I'm long at 120. My stop loss is 119.50, and my it opens on the Sunday night at 119. Where am I going to be filled, at A or at B? Let me know in the questions box. So James is saying B. Lots of B's coming in. Christopher's saying A. The answer is B. Okay, or as close, more likely to be B. And the reason for that is, if you're long and you effectively you own it, you own pound dollar. in order to close that trade, whether it's your stop loss or otherwise, you need to sell. Okay, you need to close that off. You can only sell something if someone's prepared to buy it off you. Okay, no one's going to be prepared to buy it at 119.50 when they can buy it at 119. It's cheaper. So they're going to pay 119 because that's the prevailing market rate. Okay. So when you see that a market that gaps or a market that moves super fast is going to trade through your price, and so therefore, the price that you wanted to exit at 119.50 is no longer available. The market's already traded through it, and you can only close something if someone is prepared to pay that price for it. But they're not, because the market is already down at 119 because of new information that came to light over the weekend. Now, that's not to say that you shouldn't run trades over the weekend. I have actually no problem with it. This is just simply to demonstrate a point. So if you were closed out the first available price after the open, which is going to be around about 119, just for ease of reference, effectively the difference between your stop loss and the price at which you're exiting is your slippage. So that's a 50 pip slippage. Okay, that's quite big, and you don't often have it like that, but that gives you an idea. Does this make sense, everybody? So slippage is basically the difference between the price that you were hoping to trade at and the price that your broker filled you at. Now, is that down to your broker playing silly buggers? Well, I can't comment on every broker out there, but if they're a decent broker, then the answer will simply be no. It's just because that's the price that was available at the time and the market was moving fast. So whether it's moving fast, whether it's gapping over a weekend, you can only be filled at the market prevailing price where there is somebody that is interested in taking that price off you. Okay, we making sense? Yes or no? Let me know in the questions box. That'd be great. So why is this important? It's important because instead of having a 50 pip loss on that trade, we ended up with a bigger loss. Okay, and so how can we deal with that? Because the problem is you don't tend to get slipped because of the way limits are held on exchanges. You don't tend to get too much slippage on the positive side. It tends to be more on the negative side, which means when you trade over major market news and events or and so on, where the risk of gapping and fast markets is heightened, the risk of slippage is heightened, which means the more likelihood is that your losses will be bigger than they should have been, but your targets, your wins will still be the same. That gives you a sort of a negative bias by trading in this particular way. Okay. So it can mean the loss-making trades are a bit bigger. So for example, let's look at this chart here. So there, let's say you bought it on the close of that bar at 154.35. This is a well old chart, isn't it, for pound dollar? But anyway, it doesn't really matter. And let's say your stop loss is down here, which is a pretty reasonable place for a stop loss. Okay, that equates to there. Where's your stop loss most likely to be? Gosh, look at that. That was at 9:30 in the morning on whatever day that was. That was over economic data. There was the buy. Had you have taken it, but you'd have been a bit mad too. Had you have taken it, stop loss down there. Let's call that 15 pips away. You're not going to be filled at your stop loss. You're going to be filled down here. Okay, or near as damn it, because looking at the speed in which it fell to find the buyers at that price, you're going to be filled all the way down there. So your stop distance, your risk wasn't A, it was probably more like 3A in this particular example, okay? Because you're trading at a time where the risk of slippage, the risk of gapping is heightened. How do we know that? We know that because, well, at 9:30 a.m., we had a red flag item looking at payment count change, not so important, MPC meeting minutes, interest rate information coming out. So if something comes out that is not as per expectations, the market is going to move. The more away from expectations it is, the more important, the more topical that item of information is, the greater the risk of gapping and slippage. Therefore, the less you want to be in the market at that time. Okay, is this making sense so far? Are you still with me? I'm going to ask a lot of yes nos. Is this making sense? Because it's quite an important topic. And apart from anything else, I want to make sure the sound still works. Okay, good. Okay. So what does this mean? Does this mean that we should never hold a trade over economic data? No, it just means that we have to be a little bit mindful of it. That's really all that it is. So why does this happen? And again, it's good to understand why things happen. If anyone's ever heard of like a level 2 order book, market depth, depth of market, superdome, these are phrases to describe the depth of a market or price ladder. So the reason why gapping happens over fast markets is because in a normal market, pension funds, hedge funds, traders will leave their orders in the market because they'll be, this is a price ladder. So you've got all the prices here for this particular market, and at lower prices, there are orders working to buy. So at 133 and a half, 1333 and a half, there's 190 contracts of this particular instrument working to buy at that order. And at 1334, there's 129 of them, and so on. So these are orders that are sitting there with the exchange waiting to buy if prices go down to those levels. Conversely, up here, these are orders that are working to sell at those levels. So you think about everybody that's trading that's out there, their orders, or some of them, if they're trading with an exchange, will be sitting on the exchange waiting to be filled. Now, this is in a normal market. The problem is when uncertainty comes in, and when you're thinking, oh my God, we've got an important piece of information coming up, you're not still going to be working your order, or the big pension funds, hedge funds, they're going to say, do you know what? I don't want to work that order anymore. I don't want to sell it at that point. I don't want to be suddenly like selling when the market's going through the roof. I'd rather just avoid it and not be in the trade at that point. Certainly don't want to be opening new positions at that point. So what happens is as you approach economic data, lots of orders will be cancelled. They'll be removed from the order book, and that becomes a thinner order book that creates gaps between prices, and that's why over economic data prices move much faster, because prices jump between prices, okay? Because there's no trading in between. So a lot of people think that over economic data there's a huge increase in volume traded. There actually is, but there's also a lot of liquidity removed from the market as well, which creates faster speed. So all those pension funds and the hedge funds, this is just a crude edit basically, but it just demonstrates that you then get gaps in prices. So therefore the market can move up or down more free flowing, because there's less contracts that needed to be traded, less shares that need to be bought, less currency that needs to be sold, for the price to move between those levels. Okay. Again, does this make sense, everybody? So in normal prices, you'll have a thicker, a more stacked order book over economic data. Lots of the big market movers will be like, whoa, hang on a second, I'm going to cancel my orders. I don't want to take on additional risk. I'll remove it and I'll see what's going to happen. Orders are cancelled. Therefore, the markets have the potential to jump a little bit more. Okay, good. So this is why markets move faster. The question, I guess, then is, well, what simply can we do about it? Well, this is where an understanding of economic data can be quite beneficial. So I'll talk to you a little bit second about, again, about what we do about it. And what we do about it depends on whether you're going to be day trading, whether you're going to be trading at end of day. But these are the main sort of economic data announcements that you tend to get. There are lots of them. And what I encourage you to do is be aware of the economic calendar. So you can look at forexfactory.com. There's a number of them out there. If you want to know what's happening with US interest rates and expectations, you can look at this link here. Just go to the CME group or just search for Countdown to FOMC, Federal Open Market Committee. So that's the countdown until the next interest rate change or meeting. The point about it is there are news items and there are news items. So you need to be aware of which items are more likely to have an impact on the markets than others. Okay. Now, the question I asked earlier is, in fact, why don't I quickly bring up an economic calendar? Because you can actually have a look at it and just how god awful it looks now. So if I go to forexfactory.com, it's a good site. There's plenty of economic calendars that are out there. This one's just freely available. You can apply certain filters. You can put it in your own time zone and whatnot. But what I've got here is pretty much everything. I'm just going to take off these yellow ones. They're color coded by what Forex Factory determines to be the expected impact of the market. And you can filter this if you want to. But anyway, let's just remove some of those off. So for this week, it tells me which economic data announcements are coming up. And what have I got in here? I've got all sorts of weird and wonderful stuff. So I've got German preliminary CPI, consumer price index, it's inflationary data. Okay, you can click on the button, it'll give you a bit more information about it. You could look at the Richmond, whatever that is, manufacturing index. Okay, and again, you can have a look at that, a bit of information there. Now, this is deemed to be medium importance. This one consumer confidence is deemed to be high importance. Now, why would consumer confidence be high importance? Because it's really a bit of a leading indicator. This is coming out at 3 o'clock UK time today. Why is that? It's a leading indicator because it tells us how we feel. How do consumers feel has a bearing on how much consumers spend, which has an impact on obviously inflation, price, growth, and therefore interest rates. Okay, the point I'm trying to make is there is an absolute boatload of economic data that comes out all day long. The question is twofold. Number one, which items are the most important? And also, how do we read it? What impact is it likely to have on the markets and why? Okay, so let's firstly tackle which are the most important items, and then we can talk about what we can then do about it. All right, so let's just go back to the slides. The most important items are interest rates, particularly when we're talking about indices and foreign exchange in particular. So, anyone got an idea? You can just type it into the questions box why interest rates have the biggest impact on currency prices. Anyone got any ideas? So when we talk about interest rates, this is the interest that you'll get on your bank account, basically. So, in the UK, in the US, whatever, there are certain interest rate setting bodies that determine what the interest rates should be. That's about determines what money, what interest we get on savings. It determines what interest rate we pay on loans and all that sort of stuff. Bond rates, etc., etc. So interest rates are massively important because it affects how much money is available. No, really, interest rates determine basically the rate of return you can get by holding certain currencies. Try and think of it that way. That if the interest rate in a particular currency, in say US dollar, so if they're expecting the market is more likely to, so let's say something happens in the market, which means that the US, the FOMC, the Federal Open Market Committee, the Fed, are more, oops, I spelled that wrong, FOMC are more likely to raise interest rates now. Then what's going to happen is that is going to mean that if they're more likely to raise interest rates, then that makes holding the US dollars more attractive. That means the US dollar is more likely to go up because you can get a better rate of return now than we thought we probably could in the past. So if the interest rates are more likely to rise because of the announcement that's come in, you should see that particular currency that is affected, its valuation rise. So the dollar will rise there. And all you need to do is think about it versus interest rates. Interest rates are the most important thing when it comes to currencies because everything is based on the impact that interest rate change on the valuation of that currency. So again, let's say it one more time. So let's say something happens in the UK, an economic data announcement comes in to say that inflation is on the up. What does that mean? Oh my God, inflation's on the up. That means you devalue the pound. Blah, blah, blah. What it actually means is that the economy is going a little bit faster than it should do. It also means that the Monetary Policy Committee would probably more likely to want to slow the economy down because if the inflation's going up, then it needs to be slowed down. How do you slow an economy down? Well, you get people to save more and you get people to spend less. Okay? So if they're spending less, they're taking on less loans and so on, and they're putting it in the bank. So how do you encourage people to save more and spend less? Well, you increase interest rates. If you're getting a better rate of return on interest rates, then you're more likely to keep it in your savings account. It makes a loan more expensive. It makes mortgages more expensive, which means you're less likely to spend money on things. It slows down the economy. So basically, whatever happens here is that whenever any economic data comes out, it's all based on what is the likely impact that will have on future interest rates? Does that economic announcement mean that an interest rate hike is more likely or an interest rate fall is more likely? That will give you the clue as to which way the currency is likely to move. So if whatever data, growth data, GDP, sales, consumer sentiment, doesn't matter what the data announcement is, if that means, particularly for currencies, that interest rates are more likely to go up because the economy is stronger than we thought it was going to be, then Interest rates are more likely to rise, therefore the dollar will rise if it is a US item. If it's a UK item, it means the pound will rise, and so on. Does that make sense, everybody? Think of it basically on spending and savings. Okay. If interest rates go up, you're more likely to save more because you're getting a better bang for your buck in your savings account. That's really it. Okay. That therefore slows down the economy. Does this all make sense, everyone? You don't have to be necessarily an economics whiz kid to know this, and I did a degree on it, but that's all you really need to know in terms of being a trader. Because most traders, we're not interested in the fundamentals per se, but we need to have an understanding or an awareness of where the fundamentals might come into play with our trading. So why are interest rates therefore at the top of the pile when it comes to trading currencies and trading indices? Because that's the most important item. Because everything, all of this, has an impact on monetary policy. So what's more important than the monetary policy announcement itself? So how does that work with currency pairs such as pound dollar? Okay, so well, let's think about that. So if you're going to be looking at pound dollar, so if you're buying pound dollar, that means you wanting the pound to rise and you wanting the dollar to fall, basically. Okay. So if you end up with something that says that the pound's going to do pretty good, i.e., sorry, the pound, the UK is more likely to raise interest rates because I don't know, the economy is doing super well, or inflation's high, and they're more likely to raise rates accordingly. You should find, all other things being equal, the pound go up. Whether the dollar falls is not actually relevant because it should go up against maybe a stable dollar. Or if you find that the US puts out an announcement, Colin, that says, actually, God, the US economy is really struggling. It's doing very, very well, badly indeed. In fact, really what it's more likely to do now as a consequence is cut rates because it needs to inject a bit of life into the economy because everyone's really struggling. So what they want you to do is spend more of your cash that's sitting there in your savings account. They want you to get out spending it. So there's no point sitting there at 0.25% earning absolutely naff all. Get out and spend it. So they're going to cut rates. They're more likely to cut rates than they were. That would mean that the dollar will fall. Okay. And so again, the pound dollar can go up based on whether the pound is looking more likely to raise rates or whether the dollar is looking more likely to cut rates. Does that make sense, Colin? I think, from my perspective, I think it's important not to get too bogged down in all of this. Really, it's more. There's two Collins in there. You both made sense to both of you. It's even better. So it's it's more about just have a look at it. You know, whatever instruments you're looking to trade, just have an idea about the economic data and so on. All I would say to you anyway is that really, if you're day trading, short-term day trading, you're probably just better off not being in the market in the first place. But if you're wondering, sitting there thinking, which way on earth is this market going to go? Always think back to interest rates. What would I do with my money now? If I'm more likely to raise rates, my savings become more attractive, which means I'm going to put more in there and spend less, and so on. It's the way it basically works. So all of these other items are kind of less important. I say less important, and there's a big asterisk over all of this. Unemployment in the US, there is one other item that is super important. Let me just go back to interest rates. So if you're going to trade the US, the dollar, FOMC, usually on a 7 p.m. on a Wednesday, that's when they do their interest rate setting. I think they have 10 meetings per year. You see the data. You have one about 3 weeks ago. MPC in the UK, and there's various others that are around. So ECB, European Central Bank, Bank of Japan, blah blah blah. The other thing that's super important is unemployment data in the US. Now, anyone's got an idea? Anyone know why FOMC, FOMC, non-farm payroll, NFP, non-farm payroll, is probably, after interest rates, typically the second most important piece of data? You may not know. I'm going to tell you why. And this comes down to interest rate policy. So central banks like the Monetary Policy Committee, the Federal Open Market Committee in the States, most central banks have one primary mandate, which is to control inflation, to control prices. Okay. The US, however, has a secondary mandate, and that is to foster full employment. Okay. So then most central banks' interest rate policy is based on controlling price inflation. But the US, they have a second mandate, which is to foster full employment. That means that whenever you see the employment data come out, which is typically the first Friday of the month, although it's not actually this Friday, it's next Friday because for some reason, the first of the month, so maybe they're thinking they can't get the data quickly enough. I don't really know. But basically what their mandate is, employment's better, employment's worse than expected, blah blah blah. That'll have a very strong impact on their monetary policy setting, as opposed to just inflationary pressures. So they look at that as well. That makes non-farm payroll, as I said, on typically the first Friday of each month in the US, 1:30 UK time, the most important item of data after interest rates. After that, it kind of is all less important. It's still pretty important, but it's less important. Inflation at the moment is obviously extremely topical, so that's quite important, but it isn't always that important. It just depends on where we are in the interest rate cycle, really. But normally, these other things have impact. But these items, if you're end of day trading, or if you're really cautious, these are the ones that have the biggest impact on the markets. These ones will typically have a lower impact in the markets. But that's not to say that there isn't opportunity there. Okay, so again, everybody, yes or no, are we still making sense? I know some of this might be super boring for some of you, but for others, it might be interesting. I don't know. Okay, so let's have a quick look at these links. Let's just make sure. I'm not going to go through ad nauseum about how to, wrong link, about how to use the economic calendar. You can play around with it. So for consumer confidence, I can say, okay, I can find out some more information there. Have a little look at it. Okay, have a little play around, get some information about it if you want to. Okay, so ordinarily you would find here on the Friday at 1:30, you'd find non-farm employment change. It's not here, but we do have ISM manufacturing PMI, producers managers index, purchasing managers index. Sorry, that's an inflationary item of data. It's seen as being quite important, and it will be. It's likely to have an impact on prices, and the size of the impact that it has is based on. Sorry, pause the screen for a second. The size of the impact that any economic data has is the difference between its forecast and its actual. So the more different these two are, and the higher the impact item of data, the greater the slippage and gapping is likely to be. The speed in which the market moves is likely to be. So if you go back, you can have a look back in previous weeks and months and so on. So you can have a look back and like here, for example. Doesn't sound like a lot, but interest rates. So US interest rates, FOMC interest rates there. Okay, probably the most important economic data in the entire month. We're expecting the interest rate to be 1.5%, but it wasn't. It was 1.75%. That's what it came in at. So it was raised further than expected. That had a massive shock on the market, simply because, one, it's a massively important item of data, and number two, it was away from expectations. Okay, the more away from expectations it is, the more the difference between forecast and actual, the bigger the impact on the market's likely to be. Okay. Is there a link on the market that shows all currency interest rates? Probably, but I don't know what it is, Colin. Okay. And you can actually see MPC, official bank rates in the UK, and so on there. All right, so we went up 0.25%. That was what was expected. And so if it's as expected, the market change is less likely to be that big. So it's still an important item of data, but because it came in as expected, the impact is less likely to be as big. All right. The point is that now we have a bit of an understanding about which way markets are likely to move after the event. But what's also important to know is we know the markets that are likely to have the biggest impact. So why is this useful as a trader? Number one, if you're a day trader, you'd be an absolute loon to be still in a trade. If you're day trading the Dow, the pound dollar, whatever, at 7 o'clock on June the 15th, if you were still in that trade at 7 o'clock, you're either ill prepared or you're a bit of a nutcase. Okay, that's my own view. Or maybe there's another argument. Who knows? That's a day trade, short-term day trading in and out on the same day. Because what you're doing there is you're looking to run trade over something that's got a very high likelihood to slip the hell out of you. And it's just nuts. It's a gamble. I mean, it's not even a gamble. It's a gamble that's so against you. So not in your favor because of the risk of gapping and slippage that it's going to be a bit of a problem for you. Now, that's not to say that you can't trade around that event. See, what you'll find is that after 7 o'clock, I mean, literally like 7:02, it could be fun season. I say fun, I shouldn't use that word. But it's a time where the market's going to be moving fast. That makes it very compelling to day trade. Okay, so what I say to you is don't trade the gamble over is it going to be better or worse than expectations. That's a gamble. That's not red versus black. That's like the odds are against you. The house will win. All right. So you don't want that. Who wants to do that? But trading after the market, you'll see candlesticks like this. Everyone's waiting, pausing, and then you'll start going big moves. You want to trade this bit after the economic announcement, not this bit before it, or this bit right on it, because you're going to have the problem. So let's just go back to that particular day. And let's see if I can explain what I mean by that. So if you're going to be a short-term day trader, yes, you need the strategy. Today is not the purpose of looking at trading strategy per se. I just want to give you an idea about when the markets are going to move fastest and what we can do about it. So 7 p.m., let's go back to the 15th of June. This might take me a little while. Just have a look at the Dow on the 15th of June. Just bear with me. And again, this is about having an understanding of where the markets are more likely to put in a decent bit of speed. All right, so just give me a second. So it'll take me a couple of moments. Oh, what's it doing? Bear with me. What this computer's doing is behaving very, very slowly, I'm afraid. Bear with me. Right. So let's just have a look at it like this for now. Okay. You can see, look here. So this is 6 o'clock, right? This is midnight. So 7 o'clock's like here. Okay. You can see how much the markets are moving. They're sort of reasonable moves, don't get me wrong. But if you look at the size, the difference between the top and the bottom of the channels, it's an inch or whatever. But suddenly you look here, and suddenly you've got difference between top and bottom of the channels is like 3 or 4 times the size. The volatility is increased, and that's because what happens is when new information comes out, everyone's tussling around to make sure their portfolios are aligned in the right way, or the pension funds, the hedge funds are going, oh my god, that's better than expected. Oh my god, okay, we need to sell this, close this, buy this, da 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 da. And so suddenly there's like this furious amount of trading that goes on that just increases volatility, increases speed of movement, and that's what makes it a lot more interesting to trade. Again, being in the trade at bang on 7 o'clock is a crazy thing to do, in my opinion. But to pick it up afterwards and to look at the opportunities that take place from there can be extremely attractive indeed. In fact, there was a sell trade on this system at 7:04. So this is what we call our dynamic trader strategy. There was a sell trade at 4 minutes past 7. You had a big sort of nutty spike there on the 2 minute past 7 candlestick. So again, let's see if I can just zoom in a little bit more there. I don't expect everyone to have an understanding of the strategy per se, but just look at the size of that candlestick between the high and the low. That is a 200-point bar, basically. No, it's more than that. What am I talking about? It's a 250, nearly 300-point bar. Whereas the rest of these are, I don't know, maybe 20 or 30 points. So this is a massively outsized bar. And that's for the 2 minutes that take place after the 7 o'clock announcement. You don't really want to be in there. Imagine your broker trying to fill your stop loss over that period. You're going to be filled at all sorts of weird and wonderful places, and not very wonderful places, I might add. Here, on the other hand, is the sell trade. And this is where the market then starting to pick on the speed. The market suddenly, it's got a discernible direction. It's moving in the way. It's digesting the announcement that's taken place. So at 4 minutes past 7, suddenly from there, we had a movement from what? 304.75 down to 30300, 175 point fall in 4 minutes, in 4 minutes time. Okay, 175 points in 4 minutes. Now, I say I'm not here to talk about the strategy per se, but this is something we can teach you at Trend Signal. But the point about this is that the potential from that move has suddenly got a whole lot bigger. Why? Because, well, the size of these moves are much bigger than the size of these, smaller than the size of these moves, because we're trading the reaction to the data. And what you'll find is like a ripple effect. So you throw a stone in to the water and you get bigger waves for a while, and then the volatility will slowly reduce as that movement is digested. The good news is that volatility, again, depending on the importance of the market and the data announcement, will stay there for a little bit of a while until eventually here we end up with a buying opportunities, like an explosive swing trade, buying trade there, and which from there the market went from 3,500, let's call it, to 3,900. So just under 400 points. The market moved in 2, 4, 6, 8 in 8 minutes. These are big moves, but just by having a little bit of preparation, yes, you need to have the right strategy, of course, that's granted, and you need to know when to get in, you need to know when to get out, and all that sort of good stuff. But just by having an understanding of what is the most important economic data, where don't I want to be in the trade, where do I want to be in the trades, can really help you to know when the markets are going to move at their fastest. Now, this is probably the fastest it would have moved that week. But no, there are other data announcements which will probably be a little more muted, not as much as this, but they will move faster than normal, in which case there is potential for a bit of profit from there. Are you recording the session? Yes, I am. Okay, majority of the time, price starts to move away before the actual event timing. So by the time the announcement happens, the price hardly moves. Ala, that's not really the case. It depends. There is movement usually. Buy the rumors, sell the facts. You get a lot of movement into economic data, but again, a lot of that is about tussling to reduce risk before the announcement comes in. So you couldn't say that, that was the data point there. That's when the announcement came out. And then this was the reaction there, this blooming great thing here. But there was reasonable movement as people are like, oh my God, get me out of the trade, get me out of the trade. You get a little bit of movement in the 10, 20 minutes coming into a major data announcement. Sometimes it's kind of flatlining. I always used to experience, like non-farm payroll day. So typically the first Friday of any month, but not this month, is a big data announcement at 1:30. So I often used to find that day trading on a Friday morning was usually pretty quiet because nobody wants to put in massive positions, or no pension fund or hedge fund is going to be really moving their positions around other than maybe de-risking or deleveraging into a major economic announcement. So Friday mornings on that day can often be quite quiet, waiting for the big push to come in at 1:30, and then everyone can trade, nicely after that, if that makes sense, Ala. And the size of the move after will depend on how much the actual result or economic announcement is compared to the forecast. So all other things being equal, if an inflation reading comes in at, 9%, and we're expecting 9%, then the market's already priced in 9%, and therefore the market's not really going to do anything because that's what it was expecting. So therefore, what is there to do? If it comes in at 10% or 8% or 12% and 4%, my God, that's way away. Suddenly, that's going to have a big impact on what the central banks might do on interest rates, and therefore that's going to have a big impact on the way in which currencies and indices move. Now, in terms of day trading, indices tend to be far more interesting for day trading, but again, over those announcements, you could probably trade currencies as well, I suppose. This is a 2-minute chart, Stephen. Yeah. Stefan, how would this apply to end of day trading? It's a really good question. My view on it is that when you look at an economic calendar, you have economic data every single day, don't you, Stephen M? Sorry, Stephen C. So you'd be probably forgiven for thinking, well, hang on a second. What are you saying, Adrian? That I've got to close out every trade before every piece of data, which means if I'm running trades for a number of days, I'm never going to be able to run a trade properly because I've got to close it before each individual item. I'm not really saying that. The higher the time frame you trade off, really, the less relevant the economic data really becomes, and the less sensitive you are to it anyway. The problem with gapping and slippage is that speed of movement over a few bars, but actually, that's less of a concern when you're trading end of day, where your stops are wider, your targets are wider, you're going for the bigger moves, you're less likely to get whipsawed out. So the risk of slippage is much lower when you're trading over a higher time frame in smaller size. We're looking for bigger targets and bigger stops. So it does tend to be less of an issue. What I would say to you, though, as an end of day trader, and certainly what I do, is I manage my positions according to the risk that is there. So if I've got, say, let's say next Friday, again, I've got non-farm payroll coming up next Friday, 1:30. Let's have a look at it in the calendar. Okay, so where are we here? So let's go through to July. Let's look at that week there for Friday the 8th. Okay, so non-farm employment change. So when I come up to that, if I've got $3 or $4 positions open on Thursday night, for example, I'm going to be looking at it thinking, do you know what? I've got a weekend coming up. I've got non-farm payroll coming up. I've got something that might really impact the price of the dollar. Do you know what? I might close those trades out before that data announcement comes in. If I've got one position on, I'll probably think, do you know what? I'll run with it anyway. I'm fine. But if I've got $4 or $5 positions on, I might be thinking, do you know what? It's just a bit too much risk for me. There's no point. I'm up, I don't know, 200 points on open positions. Do you know what? I'll have it. You know, maybe it goes in my favor. Maybe I'm up 300 points, 350 points. I'd rather take the 200 than the potential of losing on those trades. So I'd be more inclined to make a pragmatic decision about it, Stefan C. Does that make sense? The problem you've got is that, like, otherwise, you'd never really be in a position. This is a really interesting example here, though, and something that I would definitely suggest. So on the Tuesday the 5th, right? So you've got the 5th of July. We've got the Australian interest rate coming up at 12:30 in the morning. So typically end of day trading. So if you've got a signal on a Monday night, you're typically trading at, say, 10 p.m. Would I therefore take an AUD, an Australian dollar position at 10 p.m. on Monday night, knowing that I've got an Australian dollar interest rate change coming 2.5, 3 hours later? Would I do that? No, I wouldn't. I wouldn't. I would avoid the opportunity. I might trade it afterwards if I wanted to get up, or I might trade it the following day once I know what's happening. But effectively, what you're saying is, there, if you put that position on, let's say you traded, I don't know, Aussie CAD at 10 p.m. on Monday, you're only really allowing the trade to run naturally for 2.5 hours before a whole new potential curveball could come in. I don't really want to give a trade 2.5 hours as an end of day trade to materialize. That's just not enough. If I've got 2 or 3 days, that's fine. If I've got 2 or 3 hours, that's not really fine. It's you're putting it under too much constraints to do what you want it to do, really. Okay, so just think with it in mind. But like I said, as an end of day trader, sure, from time to time there'll be an announcement that has a big impact, but by and large, in my experience, it is the interest rate announcements that have the biggest impact. So if you're trading end of day, probably be most aware of things that happen in the Far East. So Australian dollar announcements, New Zealand dollar announcements, Japanese yen announcements. They can kind of catch you off guard because they're happening in the morning before the markets had a decent chance of getting going. I mean, I've literally seen announcements on New Zealand dollar where they come in at like 5 minutes past 10 at night. So you put your end of day position on pound New Zealand at 9:30 or something, and all of a sudden I've just gone 10 o'clock. Oh my God, what's happened? But if you know your calendar, if you just spend 2 minutes looking at it, then you'll be absolutely fine. You won't have to worry about it. Okay, so it's just a very simple pre-flight checklist that you need to do for an end of day trading, and also for a day trader. Look, just be aware where your banana skins are. That's all it is. Nobody has to be, even though I've told you a clever idea about how you can understand which way a market's more likely to go based on expectations of interest rates. It doesn't actually really help you make money. Oh, it's more likely to raise rates, therefore pound is more likely to rise. And the reason it doesn't really help you make money is because the market's going to move there before you've even had a chance to react anyway. The only thing that you really need to take out of today is to be mindful that, well, I guess it helps you to understand it, which is great. Well, why has that gone up there? It doesn't make any sense. That's why. But what you do need to be aware of, where the banana skins are that you could be about to step on. And the banana skins can be a little bit different, whether you're an end of day trader or whether you're an intraday trader. Okay. Guys, are you with me? Is this all making sense? As ever, I've talked significantly longer than I was expecting to, but hopefully this has been it's been useful. Let me know, please, in the questions box. Has it been helpful today? Has it been useful? Have you learned something? I hope so. I mean, it's really the purpose of it. This isn't necessarily. This can give you greater opportunity as a day trader. This can help you to manage risk. And I think probably sometimes you think about topics to talk about, and you think, well, yeah, we'll talk about managing risk, but people actually want to make profits. They don't want to talk about managing risk really. But do you know what it is? And I give golf analogies a lot because I've played the game since I was 7 or whatever. But um, the way in which you become a better trader, or the way in which you become and get better results, the same way in golf, right? So the way in which you become a better golfer is not by playing more good shots; it's by playing fewer bad shots. It is by removing the risk of a double or a quadruple bogey or a triple bogey, whatever. The more you eliminate risk or reduce your potential of having a horrible, horrible hole or having a horrible, horrible trade, that means that your bad trades become slightly better, which means overall your margin, your averages increase, and so you become a better trader, but naturally. So the more you look after your risk, it's boring, and nobody really wants to do it because all we want to talk about, again with golf, all we want to talk about is smashing a drive down there and making birdies and telling all our mates how brilliant we did. But actually, if you can take double bogey off the card, if you can take triple bogey off the card, if you can go round the whole round without losing your ball, you will naturally score significantly better. Trading is exactly the same. There's so many synergies between trading and golf and sport. It's just that we don't always think about it that way. Okay. What is 12:30 a.m.? Well, it's half past midnight. UK time, that is. Hopefully the golf analogies aren't too nauseating either. All right, everybody. Well, look, that's pretty much it from me. So hopefully that's been kind of useful. Feedback, as ever, is really interesting. If you've got other topics you'd like me to cover off on these Tuesday lunchtime sessions, that's great. I like to talk about all sorts of stuff, so your feedback and suggestions would be great. Sometimes I sit there thinking people want to know about this, but maybe they don't. Maybe they want to know about something else, and I can quite easily, I'm sure, I've been trading for 20 odd years, and quite easily I can thrash out a 45-minute webinar on it in the next few weeks. So just let me know. Otherwise, if you're interested in the courses, you want to learn more about Trend Signal, whether it's day trading, whether it's end of day trading, there's some contact details there. Or you can follow us. Just search for Trend Signal on Facebook, Instagram, LinkedIn, Twitter, YouTube, indeed, whatever. We're there to assist you on your trading journey. All the best, guys. Thanks very much for attending, and happy. I wish you all the best. Bye bye for now.